bars before a trade. So what we're going to be doing now, what I've decided to do as well, which is a little bit different. A friend of mine said to me, I tend to, according to them, I tend to rush through my presentations in terms of I don't give enough information or share enough about what I'm discussing. So what I decided to do to answer that and in response to that is to just check my light here. Okay, I'm not sure why my light is gone off, but I'm sure you can still see me. So I've opened up a completely new chart. My old favorite friend, which is the pound to the dollar, the cable. And I'm going to just walk through, I think at a good pace, the setup that I look at. So this is a fresh chart. I'm not trading the pound to the dollar. The currencies that we trade are just there here. Okay, so if we get a chance to look at them, we'll have a look at them. But now we're just going to look at the cable. So the very first thing that we do, let me just check questions. Okay, I've always wanted to know what you mean by bar by bar. How do I get white stops? All right, so I'm going to try and answer all of those in this session. Now, just give me half a second. My light is flickering. I'd rather just switch it off. Not sure why. Okay. All right, so we're going to look at the 6 bars before a trade. But when you get to look at the 6 bars before a trade, there's a lot of work you'd have done beforehand. So that's what we're going to build up to. Now, I'll answer all your questions. How do I build a position? How many names? Okay. So we're going to cover all of that. So imagine you said, okay, I'm going to start trading price action, the way George talks about it. And in doing so, I'm only going to focus on the pound to the dollar. And I'll be trading off the 5-minute time frame. Okay, so that's your selection. Again, remember, patterns are fractal. In other words, whatever we see on any time frame, we will see at a higher time frame. So the very first thing, one of the first things I'll do, okay, there I've opened the pound to the dollar. You need to just make sure you've put, the only indicator that I put on my charts is the moving average. Okay, so there's the process indicator trend moving average. And I will put both the 10 moving average, which when I spoke about it last time, it helps me to take trades when the market is fast moving. So it's a pretty useful one. When I observe a breakout, I'm looking for that first pullback to the 10 moving average, and then I jump into the trade. So I put that in dotted line in terms of the view of it, and there it is. So it doesn't distract me, but it's there. But then my major indicator that I really love is the 20 EMA. Okay, so this 20 moving average is exponential applied to the close. Then I just want to make that a solid line and a little bit bolder. Okay, so that's a view. But before I start to trade, it's a fresh chart. It could be anything. It could be a stock. It could be Apple. It could be an index. US 500, doesn't matter what it is, it could be oranges or pork chops, it doesn't matter. Go to the monthly time frame. Now, what you want to just get a view of at the monthly is, what are the most significant horizontal levels, structural levels of resistance and support? So we mark them so that as and when they come into our view, we can pick them up. We don't have to worry about the monthly chart at all until we get to the end of the month. Then whatever the prior month's high or low becomes significant if it is close to where we are. So there is a level to watch. Why is there a level to watch? The market can get pulled, and that's the nearest lower high that we have, the nearest point of resistance, and you want to just mark that. Okay, so just mark that level. Well, let's be a little bit more precise. So that high, 43764. 43764. Okay. we'll just mark it as green. You see this is the same logic we use when we're marking our levels on the daily time frame. Green, of course, when it appears up there, I know that there's a level of resistance that's coming up. The bears want to defend it. Bears will create this low. I want to defend it. The bulls want to break above that, because they can break above that, give us a close, then there's bullish strength, and all we wait is for pullback to back to that level. Now, at the lower level, here's what's interesting. You can see this month, let's not say COVID month, yeah, March last year, okay, huge bear move, and then market flows up into the trading range that was there. So you can mark it there, okay. And I'm not going to do much about that, and I'll explain to you why. So when I see a tail like that, I just consider that an outlier. I mean, it was pretty strong in whether that happened in a day, an hour, whatever. No one really cares, but it flows within that range. So what is significant is these levels here, that's low. So that for me is a low that I want to see what happens when we get there. If we break beneath that, then I'll be interested to see what happens down there. Okay, so that's 19149. So once you've marked this until it's the end of the month, then don't worry about it. When the market so moves aggressively to that level, this will just appear on the time frame you are trading. So that's what you mark on the monthly time frame. Then I skip the weekly time frame. Okay, I skip the weekly time frame because I don't want too many lines on my chart. But if I'm trading on a Friday, which I do quite often, then Friday morning when I start to trade, I have to mark in the key levels that I'm seeing on the weekly time frame. Because those key levels that you see on a weekly time frame, this was the end of the week. What's the high of last week, low of last week? Those become significant at the end of the week. But for now, we jump from there and just pop down to the daily time frame. Okay, so right up there we see the monthly level that we marked earlier on, and this is now what we're seeing on our daily time frame. So on the daily, so if I'd been trading this chart earlier on, I would have been very interested to just check out. So there is today that's unfolding. So the high of yesterday, the low of yesterday are key levels that I look at. Okay, so the low of yesterday, 38383. Okay, then of course we want the high of yesterday, 39106. 39106. Doesn't matter if your broker is out a couple of pips, it's not going to make much difference. You can see when it comes up, and you go to lower time frames, and you must be aware of it. Okay, so that's high of yesterday, low of yesterday, very significant. Then again on the daily chart, what else can I see that might appear in today's particular price action? I mean, if you just look to the left, if you were trading on the daily time frame, you'll be looking at what's happened in the last 6 candles. That's what I'll do to get more information. So I can clearly see that there is a lower high here that might turn out to be an area of resistance. So I don't know whether I'll get there today or maybe I'll get there today, but I'm just going to mark that because when I go to the lower time frame, I don't want to be flipping around during the day to see what's happening in high time frames. You can do that, but you don't want to be drawing lines throughout the day. So that level, 39762. 39762. Okay, so there's that particular level. There's also a low down here. Looks pretty close, but when you go to a lower time frame, you'll see there's a bit of spacing, 38026. Once these are breached, just delete them. The charts as clean as you can. Okay, so that's all I'm kind of watching on this time frame. That's all I'm seeing. If we do break above that, then I'll come back and maybe make a line up there, whatever the case may be. So from there, then whatever time frame you trade in, shift to that. Now I'm shifting to the 5-minute time frame because that's what we traded. Okay, so I've got my whole setup nicely lined up for me. And now, depending what time you come in the day, you want to just okay, I forgot to put something. The open of the day. The open of the day. You pick that up again on the daily time frame and just do that quickly. Because the open of the day can prove to be a pretty strong magnet. So there is the day, and the open of the day is 38868. Let's do it here, 38868. Pretty close, 38868. Okay, there is our open of the day. So you can see that's where you want to put the open of the day. So things don't happen randomly with price action. There's always information that's provided to us for us to know and understand what's happening. So the market can bounce around that. So that's a pretty strong magnet. Whichever way, if the bears were strong, they gave us a break out beneath that level, which they've given us a follow through. And then we look for a test, and we can look to see how we trade. Right now, we're still drawn around that. Until we get a significant break out of that, there's no trades to take at the moment. The other thing that I just keep moving around is this indicator. It's not an indicator, it's my personal indicator, this line, which shows me where this particular session opens. So 5 minutes before the session, my vertical magenta line is there. I'm always keen to see that first candle on the 5-minute time frame. Who is controlling that? So, we had a doji on the open. So this unfolding price action is not a surprise to me. I use 5 linear weighted average. I use the exponential moving average weighted applied to the close because it gives more value to the most recent closes. So it's 20 EMA, but the most recent closes are weighted a lot more because the closes are more significant with any bar. Where did the market close? So that's why I use the exponential weighted and apply to the close. The linear weighted average, I've not studied that to understand how it computes and where it's applied, so I can't comment on that. But the exponential moving average applied to the close weighs the closes and the close of every bar, every candle, whether it's any time frame is the most important. Who closed? Like here, the bears control that candle because it closed near the low. Very significant. Then you can try to ask what is the close, what is the context, etc. So this is the kind of daily context that I have on any chart that I'm trading. I mean, you've got to absolutely have this as the minimum. When things start to appear in sight, you're not too surprised. You can see all those that you mark those a monthly level that might turn out to be significant. So double check immediately, it's fine. You can see on the daily time frame things that can pop up, and you're not surprised if the market starts to react off that because we've been given sufficient information. So if we're in this, we are in the cable pound to the dollar. So what are we looking at right now? At the present moment, we just have to wait. The market is going sideways, bouncing around the open. What do we need to actually see? Because there's always information. So from the high of the open, okay, to the attempted break beneath high of the open of this session, to the attempted breakout beneath the open of the day, okay, it's a little the trading range. up and down and sideways. And what we'd like to see is if the bears are strong enough here, like I said, they will have broken beneath this, giving us a pullback. And we have to understand what we define, what we mean by breakout. So when you say, oh, yes, George, the market broke beneath that level, let's look at the 6 bars preceding where we say the market broke out. Okay, so the market broke out beneath that. Fantastic. Are we going to take a pullback trade? So imagine if market had turned here, okay, and given us a bear candle, would we trade that? Or what are the 6 preceding candles, bars before that? We go back to the left, we look and then we see, okay, there's a bear candle tail, which means it's buying into the close. But there is the bottom of our early trading range, up and down here. We have one breakout candle. A breakout is when you have a breakout candle and a follow-through candle of the same kind. So we need at least another bear candle. So we didn't get it. So immediately in my look to the left, if I did the setup here with the 6 candles, I've got questions in my map. So if the bears are strong, why didn't they give us a complete setup? So whichever way to set up, you don't want to take that because it's not indicative of strength. If, for example, this candle immediately turned and became a strong bear candle closing beneath the low, are you going to take that trade? Well, look at the 6 candles before. It's a trading range. We're breaking out beneath it. We need to follow through. Even if this candle closes up here or even further up and strong, are you going to buy that? No. Look at the candles, the bars to your left, 6 bars to your left. What are we seeing? You know, immediately before market is going sideways, and 5 and 6 candles was bullish strength. But if the bulls were strong, why did they not at that stage give us the breakout that we're looking for? So you may say, well, George, how do you stop? How do you stop yourself taking the trade? Now I'm just going to combine a few other things that we've spoken about in previous weeks. Whenever you see a trading range of sorts, be it one candle like that doji candle, okay, that we had there, or a series of bars, or a prolonged trading range, you always want to put a measured move and say, if we got a breakout above the trading range, price action tells us that the bulls who are breaking out above the trading range, the initial target, whoever's creating that, is to get to a measured move. So whoever is taking trades here and creating this in the market, because there are people taking trades, they want to get there, take out their profits wherever they can. For us, fantastic, that's been created, that's good bullish strength in this particular candle. So the bulls are strong. Let this candle close on near its high, somewhere near its high, and then they give us a follow-through candle. We need a breakout candle, then we need a follow-through candle. To get the follow-through candle, then we are happy with that because now we know we've got bullish strength. Okay, we have bullish strength. So what are we going to do? Well, we're going to wait for a pullback, but we keep our eyes on the left. So we get a pullback. If we get a decent set out here, because we are right up here, we're not going to take that trade because of that potential level of resistance that we have. But if the bulls are strong, they'll give us a breakout, follow through, give us a pullback, or a follow through candle, break above that. We'll still get plenty of time. Now confirmation of bullish strength, plenty of time to take trades with tight enough stops and move in the direction of the market. Just something, let me just show you quickly something as well. So if we were here, okay, and for some reason, whatever reason, you say to yourself, oh, okay, I see 2 successive bear candles, there's a pullback, and you put an entry beneath here because market might call my way. Well, look to the left. What is happening on your left? That's what you always need to keep an eye on. So whether the 6 candles preceding the signal that you want to take. Okay, so if you want to take that as a signal, you look back. Okay, here's a 2-bar reversal. That's not good if you're a bear. a 2-bar reversal, but where is a 2-bar reversal? That's not good. Or it's at this low, okay? But also more important, you've seen a doji, a trading range. Do not ignore this trading range. Every time that you do see a trading range, remember you can put the measured move, okay? And it works all the time. There's a trading range. The market breaks beneath that, it's likely to get to a measured move. So it has gone to the measured move. There's profit taken. If the bears were strong for me to take this, I would want to see a follow-through candle to show their strength, breaking beneath that low, beneath the measured move, and then pull back, and then we take the trade. So we're not just jumping into trades randomly, but we're starting to understand what is unfolding before us, what is happening before us. So if we're watching this, and we keep on watching this, because we'll scroll back and find where trades occurred and look at the 6-bar pattern before that. Now, by the way, there's no magic to the 6 bars. It's just something that over experience, you train yourself to look at. You can look at the last 7 bars, 8 bars, 12 bars, but 6 bars, it's a rolling last 30 minutes. It gives you information. It just prevents you from getting sucked into the market because you're seeing something happening. Gives you time to pause and say, okay, whatever is set up here, is it within my strategy? And yes, if it's my strategy, let's execute. And we spoke about it yesterday in terms of, last week in terms of trader psychology. If it's in your strategy and it sets up and everything lines up, and by lining up now, I'm giving you one extra bit of a little bit of information. Look, you've got everything set up, but just narrow down and look at the last 6 candles and just assure yourself that the things that are setting up are correct. That it kind of slows everything down nicely on this time frame. But you also gotta be prepared to wait for things to set up. I mean, we are almost 2 hours into the European London session, and on the cable, according to the strategies that I'm discussing and sharing, there is nothing that is set up for us to jump in and trade. If you say, oh, let me jump in here, jump in there. If you are scalping and just going for short moves, you can do that if you're quick and fast enough. But we want to trade our strategies, trade carefully, trade slowly, and just wait for things to unfold before us. So let's keep that there, and let's come back and see what we have. So what I want to do using the very same chart that we have here, so that I'm not predisposed to the ones that I'm trading. Let's just scroll back and see where we could have taken a trade. Last week, I think the psychologist said it was the previous week. Last week we were talking about trading pullbacks to the moving average, pullbacks that should be profitable to us. Now, just by a quick look, it would look like there's a pullback in trade. So let's have a look at it and let's try and bring everything in, including before we were to execute the trade, looking at the 6 bars preceding the setup. So at some point, you would have seen this side was price action. You would have seen that, just to highlight it for us. And you have said, okay, the market has gone sideways in this particular area. What do you think of hedging without stops with smaller size? I know scalpers who are very good at scalping. Some guys that I know are able to trade without stops. They're in and out very quickly. But these are professional, seasoned guys who've just done this forever, and they found that works for them. And that's scalping. I don't do that, and I don't subscribe. I don't recommend that you take trades without stops. You've got to put a stop in the market. If for any reason, and we're talking of trying to look at that pullback, but let's just say you wanted to take a trade here. Okay, technical level is somewhere down here. If you want to take a trade here, your stop has to be down here, which means reduce your lot size, so that if the market turns aggressively against, which it can, in one single candle in the first minute, the market can just reverse dramatically and keep going down. If you don't have a stop in, you're not going to be fast enough to stop your account being damaged. So always best to put a stop, trade small. If you get stopped out, it's perfectly fine. You can have, out of 100 trades, out of 10 trades, you can have 4 or 5 going against you, 6 going against you. It's perfectly fine as long as you trade in according to the strategy that you have. So I'd recommend not doing that. Always have a stop in the market. Okay, so I hope that makes sense. But happy to debate. If you contact the administrators, I would like to understand how you do it. Okay, so you'd have seen this, and you'd have said to yourself, well, if the market breaks above this trading range, there will be a pullback of some sort. That's a level, a hidden level of resistance. And guess what happened? Yes, there's bullish strength in there, bulls, but pullback. There is a break above the channel. You want to see a follow-through candle. That's the absolute minimum that the bulls can do. I prefer to have a candle that breaks above the breakout candle and still close with a bull body. But there, the bulls did the absolute minimum, and then we had a decent enough follow-through. So that is a breakout. So 4 candles, bullish candles. So happy with that, but we're not going to trade that. Let's wait for the pullback and see what you get. But now your problem will be, if the bulls are strong, why are they creating dodges? Why aren't you getting strong candles? So we then get 4 successive day candles, a pullback at the 10 EMA. If you want to take that, you can take that. There's nothing wrong with that trade, in spite of what you've seen here, because you have also said to yourself, if we break beneath that, if the bears are strong, then we get that measured move. If we break out above that, immediately above that, we would have gone to that extent. But we didn't break out above that. There was instead a pullback, and the market went backwards, pullback to the 10 EMA. So if you take that trade, talking about the way to place your stops, you gotta go back to the nearest technical level. There is a higher low where you could put your stop. If you want to break and put your stop, fine. You can put a more conservative stop here. Obviously, if you put in a stop here, you'll be trading a bigger lot size than if you put your stop down there. Provided, of course, you keep the risk at a level that you're comfortable with. It's a good trade to take. But now, if you're looking to take that trade and you're thinking to yourself, as this comes down, you're saying, okay, if the market turns here, it will turn EMA because of that breakout. If it turns here, what is happening with the 6 preceding bars to give me comfort to take the trade? I'm happy with all of this setup, but what's the most immediate thing that is taking place? So somewhere in here, you'll be asking yourself, saying, okay, I'm kind of here, the bulls have created a doji, why are they not strong enough? Then I get an inside candle, then I get an entry. So it's a decent entry for bears selling beneath that inside candle. I'm still observing my bullish strength that created this, but I'm not entirely certain the bulls are still strong to carry on with the breakout. Okay, but let's see what happens. The bears have created that entry. If the bears are strong and they now give me a follow-up candle, okay, so you're observing the market that closes beneath this rise in 10 EMA, then I'm going to start questioning my logic of a strong bear breakout, because they might just come back as market close. That is an outlier. Okay, so you could put the height of your trading range there. You can see that was tested. So you could put that there. The breakout above that test and the second test, or You can just keep it here and see that it's an outlier. It doesn't matter. Same kind of logic in your thinking. So then you see a small bear candle, and you kind of say, oh, okay, that's interesting. I thought the bears would be able to break beneath this trading range. I candle at 1 bar trading range and close beneath that and maybe try and go back and create a new low or whatever, maybe 10 here and start again. But they didn't. So you're still prepared to look for your pullback trade. But these 6 bars is what are giving you information. Then let's wait and see what you get. Then as you follow through entry beneath that, but reversed and closed above the moving average. At that stage now you've got to say, okay, there's something wrong with the case for the bears. The bears were strong. They will put a strong candle, close beneath that, they will follow through and maybe be testing the moving average. So I'm going to be ready. If I get a distance setup, my stop is to be down here, do my measurements, whatever lots, have it ready on your order ticket. And if you get that, then you just put your order in above that, plus 2 pips. I just tend to use plus 2 pips as a standard so that I don't get triggered incorrectly, but you can use whatever you want. I know some guys use 5 pips, etc., which is their choice because then they manage it on higher time frames. You can work with that. But in this time frame, I just put the height of this candle plus 2 pips, and I get to my low minus 1 pip, whatever the lows, put the order in. You might not have been triggered there. Now, if I don't get triggered by the candle immediately after, I'll take off my order. Because I'm saying to myself, well, what happened? I'm expecting the rules to get in. They can trigger me in and pull back is fine, but I didn't, so I'll take it from. You get a very small doji, you get an outside small doji, and this is breakout mode when you get an outside candle with another outside candle. So something is going to happen, but we don't know what is going to happen. So that low is still significant for us, okay? Because market tended, but let's see what happens. Then you get another outside candle. So with an outside candle, that one is an outside candle. The bears at some stage, if you look at this candle, where did the market open? It jumped. There was a bit of a gap up, and then the market sold off and closed near its low right here. So now you say, okay, so maybe the bull case is waned, okay? But I still have the 20 EMA. I still have the 20 EMA. That for me is still a significant level. That's weighting the closes, weighted average of the close of the last 20 candles, and it's rising up. So the bears are this strong. Let me see if they can follow through, put a close beneath that moving average and a close beneath the slope. But the bears failed to do that. Now you're back in the game again with a bullish case. Now what do you do here? You've got to now look at it and go back to your case and say, okay, maybe in this particular case, the bulls are strong, but how far can this bullish price action go? So it will go that far. The height of that breakout, market might go that far. Or this whole move here could be a two-legged first move. Okay, went up, came down, went up. So that could be the first move. And there could be a pullback. We spoke of, besides measured moves, we spoken of leg one pullback, leg two extensions. So you can stick that in again into your chart. So there is the beginning of the leg one, and it goes as far as where the pullback begins. Okay. And so leg one, pullback to where the trend resumes. So that kind of gives you an indication. So if we do carry on beneath here, the market still has the potential to go to that extent. So what would you do? You put an order above here, because now you're trading that. You put an order above here, okay, and your stop can go in two places, beneath here or you can put it beneath you. It doesn't matter. One, of course, will be higher risk than the other, because you're trying to go for this. If you're trying to go for a one-to-one, just go for that. If you want a more conservative one, it should be 0.5. You go for the stop down here. But as you've placed your order, remember we've been working bar by bar. You know, if I go back the 6 candles before, there was a bear attempt to break beneath this little breakout candle, breakout pattern, which is an outside, an inside candle, but immediately turned. At the 10 EMA, we didn't even get to test the 20 EMA. Okay, 1, 2, 3, 4. Okay, I said the bulls that created a decent higher low here, but it was not triggered, so bullish strength. And I see other candles of bears falling to close. So I've got much greater confidence to place a trade, which means this is a trade that would fall into my 60-40% probability of success. So you place it in there and you trigger it into the trade, and your stop is there or your stop is down there. So what you always do, you can take your profits off at the measured move, because you expect that at a measured move, which is a hidden level of resistance, the market is going up, or a hidden level of support, the market can react and turn there. So a lot is happening here. There's a measured move above this breakout, above the trading range. There's a leg 1, leg 2, measured move that's in there. So there was profit taking. So what I've said to you guys before, what I tend to do, depending on what's happening in the market, I tend to observe. If I'm in the market, if I'm going somewhere, I just put a take profit there. But if I'm in the market, I want to just hang around and see what's happened. Because yes, there will be some form of a pullback. Always is at a hidden level of support. Whatever it may be, it could be this candle, which then turns and becomes a huge bull candle, or it could be a strong bear candle, and then reversal following immediately after. So I want to see if there's just a little bit more beyond the measured move that can allow me to take a little bit of profit. So nothing in here would have caused you to close the trade, because you always want to wait for the candle to close, or the market starts to trade significantly below that candle, then you can manually close your trade. But in any case, what's interesting here is that we have this move here. What is this move? Do you ever look at it closely? So we're that high there. Okay, so we have that breakout candle. We will follow through candle. Now, there's something immediately that must raise alarm bells in your mind in terms of this follow through candles, because you don't just quickly jump into the first trade that appears before you. This candle grew large as it moved towards the hidden levels of resistance. The measure moves and the leg 1 pullback, leg 2. That means that cluster of levels there that cluster of levels there, hidden as they are, is a magnet that pulls the market up. And if you are a bear, whether you're a computer or looking bearish, if you've seen that, you're just going to wait. You're not going to jump into the market. Let's wait for the market to get that and start to sell at a better price, because bears can start to sell at a better price. And if they sell here, they have to do a measured move the other way to put their stop somewhere up here, because they're saying they might be a little bit more. So this breakout is fantastic. Take profits and wait. Now, what I said earlier on is I'm always looking for the first test of the moving average, the 10 EMA in strength, and then a test of the EMA. So there we go. The first 10 wasn't triggered. We were fortunate for the second one. Here, market pulls back, and we get a pullback at the 10 EMA. Now, the only problem with this candle is that it is an outside candle. I don't mind a candle starting its low and closing its high, but a completely outside candle is a bit of a concern for me. I'd rather wait for more information. because I consider it as just a large trading range. Breakout mode, the only way to see what happens, is an attempt to break above that, a pullback, based and strong enough to put successful break beneath this at this time. Market goes sideways, and then we get that entry. Now, this type of entry is what we call a wedge entry. A wedge is any form of three push pattern. You could call it a triangle, three move, but it doesn't matter. It may not look exactly like a triangle or a wedge, but there's three attempts by the market to resume in a certain direction. And then the third attempt, if you get a decent setup, take the trade. So here, market went up, pulled back. First attempt by the bulls, which we didn't take. Forget about this this green line. Remember, we set it up as we were preparing for our daily setup. So just keep that in mind. So first attempt, you see going sideways. There's a second attempt by the bulls to resume the trade. That trade, if you wanted to take that trade, you could take that trade, and you can put your stop here. Okay. Just going to add something else we've spoken about. So, no way to put your stop in is a huge breakout candle preceding the price action. You can always look for a 50% pullback of that candle. Because 50% pullback in terms of price action, 50% level is highly respected in the market. So, it's another hidden level of support. So, you put your stop beneath that, okay, which is the same as that. So, you can see the market there tested. The 50% could be that large breakout. So you could take that, put your stop there. Or if you don't want to take that, you want to wait and see what happens as you move towards the 20 EMA. You then get another. This is almost a classic setup, a beautiful setup. That, you must take. Just take that trade because it's a wedge. 1, 2, 3. It's a wedge price action. And also, we get a low test bar and a decent reversal candle, inside candle. When all the ingredients are there, off the 10 EMA, so you put your entry above that, you put your stop beneath here, and how far is this likely to go? We're always going to put in these measured moves and see where it's likely to go. So it might get there. And if it gets there, so it's 4 pips or 5 pips, you might get just 1-to-1 or not. Market starts to go sideways, then you can decide what to do with your trade. So again, if we were taking, looking at this candle, say, should I take that? If you ever look at the price action to the left, you're looking at the 6 candles to your left. And immediately you would have noticed this candle. You would have also noticed all the preceding price action, which is always important to bear in mind. What is happening with all that preceding price action? If you're looking to take this particular trade, well, you've seen this outside candle, and it's a potential breakout mode. The bulls attempt to break, they fail. The bears attempt to reverse that, follow through candle, they fail. There's a decent 2-bar reversal. At the moving average, you can take that trade, put your stop there. If you didn't take that trade, you come to the wedge trade that we've just looked at. So the point is, follow your, continually assess the market, see what's happening. But before you execute the trade, after you've seen everything, just zoom in to say, okay, what is the information that I've been provided in these last 6 candles, and can I trade off that particular information and see if that's something that I'm prepared to trade in? So let's just in here there's a pattern which we'll talk about at some stage, major trend reversal. We might do it next week. We'll see how it goes. How do we look for trades? We're coming from bull trend with the range. How do we look for trades going the other way? So we'll cover that at some time. But suffice it to say, with everything that we've kind of shared so far, we can quickly understand how to look for trades. So you can see here the market's gone sideways. Okay. Sorry to jump, we talk about trend reversal, but there is a trading range, and we know the market has started selling off. So there is a breakout candle beneath that low. There is follow-through candle. Fantastic. We are very happy. Now we're waiting for a pullback to the EMA. Let's see if we take it. There is follow-through, so strong bear breakout. Then, of course, the pullback that you're waiting for, and we get that kind of a candle buying into the close. Not perfect, but there's nothing wrong with taking that trade. Because there is your breakout leg confirmed. There's the first pullback. Didn't get to the 10 EMA, but absolutely fantastic. We put an order beneath that, and we've put our order beneath that. Our stop is going to go all the way back to the beginning of the breakout candles. That's the most conservative, or you can put it above there. But that's a classic trade you have to take. Then I think someone earlier on, probably last week, said if the trade is going against me, what do you do? Well, you got to hold on to it. In a breakout like this, remember I said last week, I think I said, you always got to ask yourself, well, what is happening at the EMA? You get to the 10 EMA, 4 strong candles. Get to the 20 EMA, you've not stopped out. If this had been a huge spike or down, they've been stopped out, but that's how it works. But here you're not stopped out, and you're still waiting to see what happened. Then, of course, the bears failed. I mean, the bulls failed, and there was an immediate bear reversal. I wouldn't advise you to take this trade. This had been a bear candle. This one here, the bull candle. A high test bear candle, or if you had an inside candle, somebody will take a trade there. Okay. Still, your stop is to go there until we break beneath that, then you can look to tighten our stop. So if you've taken that trade, so here we've clarified easy in terms of the 6 preceding candles for you to say, let me take the trade. The fact that it reverses, now we're looking at it, does not matter. It will just carry down strongly down here. But you look at the pullback. I expect a pullback in a breakout. Fantastic. I look at the 5, 6 candles before. There is a decent breakout. There's follow through, more candles, etc. So let's take the trade. Now we've taken the trade. How far do you think the trade will go? There is the measured move. There's the height of our breakout. Measured move, market may likely to get that far, and they did get there. The other one that you can put in is, of course, your leg 1. So that's the first leg. So that's the first leg right up to there. Okay, and that's where the pullback started. Leg 1, pullback, leg 2. I'm expecting that the market will get to that level. Then you have all of this, and now you say, okay, after I've seen this, I'm still holding on to my trade there, and I want to see how far this is likely to go. Should I hold on to it? Should I take it off? What should I do with it? You've got another measured move, you can see, from this height to this low, up high. If it breaks beneath that, it might get to down here, but it didn't. Okay, so the earliest measured move is where you want to look to take a profit. Okay, this is all super profits. It would be fantastic for the breakout. But out of all my measured moves, measured move, leg 1, leg 2 extension, there is the earliest. So if I see a 10 there, then I'm going to take my profit there. If you had set the take profit, always set it just above the earliest profit. Take your profit. And take the trade. So there would have been nothing else to take in that particular thing. Now, let me just check that I answered all the questions that came up. Okay, so I spoke about the linear weighted, reading about stops, and mentioned that. Okay, how do I build a position? How do I get white stops? How do I build a position? Okay, so a white stop, for example, here's a white stop. So if we take a trade here, there is my breakout move. I'm going to put my stop here. Right? If I want a wide stop, in other words, give myself room and allowance that the market may bounce against me, I'll go to the highest technical level. So, okay. So that should be a wide stop for that particular trade. Okay. This would be the tightest correct stop for this particular trade. Then of course you just reduce your lot size, then just let the market do whatever it's doing. It's a few pips above here, so if you had left it, you might have stopped off there. But at that stage, you should have come out of your trade. Let's look at what we spoke about here. So a tight stop, if you take in trades, a tight stop would be here. That's a tight stop. A wide stop will be down here. Okay, so if you're taking any trades in here, there's a tight stop. It's always at a technical level, high or low. Okay, if you say I'd rather have a wide stop, so in case the market goes against me, I'll take it there. Now, when I use wide stops sometimes, because you're not quite sure 100% of your reading, that's fine. So if I use a wide stop, and if my risk size says to me, I should be putting, for argument's sake, one lot in the marketplace. Because I'm using a wide stop, I'm saying I think the market will come back against me. So I'm only going to trade 0.5. Okay, instead of the full risk, I'm going to trade 0.5 because the market comes back against me and creates a double bottom, high, low, down here. I'll put in the other 0.5, still at that same stop, in which case my total risk is still limited. If you really need an extra wide stop, which is still correct, instead of putting it beneath, because you're taking a trade here beneath this trading range, you can just put a measured move of that trading range and say, I may be wrong. The market may come down, create a double bottom, higher low here. Now, if you put your stop there, okay, so you're taking a trade anywhere here and you're putting a stop here. And again, the same principle is going to use a wide stop. The part of the thinking should be, if I'm wrong and the market moves against me, I need to be able to take an additional trade so that when the market resumes, my total risk is the same risk, and I'll essentially get over break even and make profit on both. That's how we do it. What other guys do for using wide stops, and it's still fine if you're comfortable doing that, but you must know that upfront your risk is increased. They would say, okay, I risk, argument's sake, 1%. Okay, size it correctly and put my stop here. If the market moves against me and creates another entry here, double bottom, higher low, on that same stop, I'll put another 1%. Okay, so when this 1% gets to this level, I made profit, broken even on that, or somewhere halfway through this, I can break even on both trades. It's a way to trade. You just need to think through the numbers. You need to be comfortable that you're not increasing your risk size and you can manage the trade correctly. Now, let me just talk quickly about the other thing in terms of how do I build a position. You build a position for argument's sake. For this, let's assume there were 3 potential trades we could take here. Okay. Forget about our analysis. So let's say you decide, look back at everything happening here from the open of the day, you see all of that, and you say, okay, fantastic. Market is broken like that, full back, double bottom, high low. I'm going to take this trade. So let's say you're happy with that. You take that trade, you put your stop here. That's your, let's say you risk 1%. There's 1% boom in the market. Then you sit back and you wait. Wait to see your price action unfolding in front of you. So price action unfolds as we analyzed it, and now you see that and you say, okay, I like the way that's set up. I'm going to put my entry in, put this to correct place. So we say that's for that trade. I'm going to put my entry here, and I can put my stop here for that. So you have, let's just do this quickly, I think it's quite interesting. Okay, so just want to show how you do the position. It's not neat, guys, but I'm sure you're following through into given a lack of neatness. Where is my way? Okay, so you've said you're going to take this particular trade here, firstly, and you've put your stop here. Okay, then you come later on. I'm just going to work a little bit fast. And you decide to take that trade, and the stop is here. So you're already on 1% here. You're putting another 1% in the marketplace, and your stop is here for that. As soon as you've done that, okay, whether you're triggered or not, this stop here then moves to that level. Okay, so you've kind of reduced your risk already on that 1%. And it's still a bit of a risk. But then, you come in against it. I was not triggered. Okay, fantastic. I take that trade, and I put my stop beneath here. The moment you do that, you move all your stops. All your stops come here. So now you are in that particular trade. Okay. So you're in the market for 2%. At that stage, that one is in the profit. That's still at the correct level. You do all the analysis as we spoke about. You put your entry above that. You could have been triggered or above that. Now your stops are beneath this candle here, and then you move all your stops to here. Okay. So at that stage, you triggered into that trade. Your stops are in the correct place. The market starts to move. And it starts to go backwards, you might close your trade. But you've built a position. You're now in 3% in the market. And if you look at that at the end, you could end up with easily 5% or so on this particular move by managing that trade. That's why it's important to put your stop in. So if you're wrong, you can still be able to trade and take these trades as they come along. Guys, I hope you found this useful. So we kind of combined a lot of things together. There's a bit of psychology in there. There's measured moves. There is leg 1 or 2 extensions, breakout of trading ranges. And when everything is set up, when you see your signal setting up, ask yourself what's been happening in the last 6 candles. What information have I got, just to give you that extra edge, to make sure you're taking more profitable trades. Next week, I think we'll look at major trend reversals. How do we transition from trading a bull trend to a bear trend, and how do we get profitable trades out of that? Thank you, guys. I hope you found this useful, and I'm just going to hand over back to the administration team if there are no more questions. Okay, I think there are no more questions. Okay, thank you, guys. We will see you again next week, same time, same place.